You probably know your PC can give to charity. What most people don't realize is that PC or personally is usually the wrong question. The bigger question is whether you're handing over cash or an appreciated security, like stocks. For cash, the choice between corporate and personal is roughly a wash. For appreciated stock sitting in your corporate investment account, the wrong route can cost you several $1,000s in tax and shrink your tax free capital dividend by half. Same dollars given, same charity, same circumstances. So let's take a look at this. All right, the short answer, it really depends on where the money sits and on what you're donating. Cash gets one analysis, appreciated stock gets a different one. Now, this looks again like one question, but it's actually two. First is where is the money sitting? And then second is this cash or is it an appreciated security? Cash or something with an accrued gain, like publicly listed shares in your investment account, is what we're talking about. So the answer really depends on both. Doing some quick math here, the corporate deduction saves about 23%, roughly. And again, I'm an Alberta CPA, so I'm using Alberta numbers. The personal credit saves about 54% at top combined rates. So personal looks much better on paper, but pulling cash out of the PC first costs you eligible dividend tax about 34%. The tax credit advantage and the dividend route roughly cancel out. For cash, though, both routes land in roughly the same place. The real swing here, several $1,000s worth, is on appreciated securities. So we'll come back to that. Let's take a look at the rules. So where are we getting these rules from? Why am I saying this? In case you want to do your own research, Section 110.1 is the corporate deduction here, where a corporation can deduct the eligible amount of a gift to a qualified donee. That is perfectly fine. Section 118.1 is where an individual can get a tax credit, non-refundable credit based on total gifts. And then 38, 8.1. This is the interesting one. Yeah, zero inclusion rate on gifts of listed securities. So taxable capital gain is deemed to be nil. So all three of these rules, they're written into the Income Tax Act, so they are pretty set in stone. There is a CRA layer again on the CDA mechanics here, but the core rules are pretty clear. They sit in statute. Now, the appreciated stock exemption, that's the good news. So where the math actually begins to swing. So let's say your PC's investment account holds $60,000 of publicly traded shares. Let's say your adjusted cost base is $20,000. So you have a $40,000 accrued gain. You have a choice here. Do you sell first and donate the cash, or do you transfer the shares directly to the charity? Now, this is a situation where we're looking at listed shares, mutual funds, ETFs, that sort of stuff, publicly traded securities. So in this case, you could have zero inclusion on the capital gain if you transfer directly. If you sell first, half of the gain is going to be taxable. At the Alberta general corporate rate, that's about $4,600 of corporate tax. If you transfer in kind, though, and the taxable capital gain is zero under Section 38.8.1, that's great. And you get the full charitable deduction at the fair market value. So that would be at the 60,000. Now, as well here in this situation, with this exception, you get a full capital gain to your CDA. This is the kicker. So on a sale, your capital dividend account picks up the non-taxable half, 20,000. On an in-kind gift, the full 40,000 goes to your CDA. So that extra 20,000 can come out to you from your PC as a tax-free capital dividend. Same shares, same charity, same deduction, but no tax on the gain and double the capital dividend. All right. So let's take a look at some of the traps and kind of what not to do, really. First, selling appreciated stock before you donate. If you're planning on donating the proceeds of stock that you hold, just transfer it directly. The downside here is if you do sell before you donate, about $4,600 of corporate tax that simply didn't need to happen, plus half the CDA bump. And so transfer the stock, don't sell first. Another trap that I see is treating a gala ticket as a full donation. a $500 ticket with $200 worth of dinner and entertainment. The eligible amount on your receipt is $300, not $500. So that's the split receipting rule. The advantage you receive reduces the eligible amount. As well, kind of a more rare scenario, but carry forwards lost. Carry forwards of donations if I guess if you do sell your PC, excess donations can carry forward for up to 5 years, with the oldest used first. So in a situation where you were wrapping up the PC and then kind of selling, essentially selling your PC, selling your practice, then yes, make sure to use those donations before the sale closes. Now, how do I recommend you handle things? I err on the conservative side. Your situation may differ. This is what I would recommend without knowing the exact specifics of your case. Generally, donate cash from where it's already sitting. If the cash is in your PC, let the corporation be the donor. If it's already personal, then write the check personally. Don't transfer money around just to change the donor. The credit and the dividend tax roughly cancel out for cash. As well, transfer appreciated stock in kind. This works whether the shares are in your corporate investment account or your personal account. In the personal case, your capital gain would be zero under Section 38A.1 in both cases. And in the corporate case, you also get the full CD8 bump. As well, you have a 5-year carry forward for donations here, so use the oldest first, plan around that. Now, there are a few other topics here that are related to donations, which are larger topics and deserve a little bit more of an in-depth look. This was just a surface level one. Gifts at death and from the estate. So will, gifts, and graduated real estate donations have their own rules. I talked to a lot of people, and a lot of people do have excess retained earnings that they accumulate and assets in the PC, and start thinking about legacy and what they leave and how they want to donate. All of that is a much bigger topic. Same thing with cultural and ecological property gifts. Here you have higher limits, longer carry forwards, certification requirements. Another issue that I do see here is donations of flow through shares. Different set of rules here. There is another deemed additional gain. The CDA result follows slightly different rules than a plain in-kind gift of listed shares. So that's its own topic. It's a little more complicated. So in summarize, let's wrap this up. If you remember nothing else, either pot works for cash donations, in-kind for stock wherever it's sitting. For appreciated listed stock, transfer the shares directly to the charity from whichever account already holds them. Don't move them between accounts first. Don't sell first. I hope that helps. Thanks very much, and I will talk to you soon.